Thank you for joining us for our Seaspray Making Waves podcast series. Brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves Podcast.
Hello again, and welcome back to episode 6 of the Seaspray Making Waves podcast series. Before we begin, just a little reminder that the podcast series is available on the Apple, Spotify, and YouTube platforms and directly from our website. You can also subscribe for free to our dedicated YouTube channel. And from the website, you can subscribe for free again to our suite of market research, particularly our weekly market review, which is available every Monday morning. We'd be delighted if you could follow us on LinkedIn, like and share our content from the company page. That would be much appreciated. So for today's discussion, the plan is to take a look in the rearview mirror at the first quarter and look ahead at some key events and significant macroeconomic data in the coming months and for the rest of the year. And joining me for today's discussion, I'm delighted to say, returning are our two regular contributors from Seaspray. We have Paul McGowan, Managing Director of Seaspray Financial, and Danny O'Leary, Head of Seaspray Private.
Morning.
Welcome back, guys.
Good morning, guys.
Good to see you both. The months have flown by.
Fast.
Yes. So, in many ways, the first quarter, it's been a bumper first quarter for global markets. Inflation continues in its downward trajectory. Developed economies are manifesting a certain resilience and slow growth, but there are headwinds that we need to be mindful of. Not least of all, the geopolitical unrest in Gaza and in Ukraine, the uncertainty around interest rates, and what seems to be a bumpy road towards that 2% inflation target. So given all of that, Danny, how do you see the scenario developing for the global economy in the coming months?
I think when we look back in the rearview mirror, if I look back in quarter four, we were anticipating, or the markets were anticipating that, there would be a lot of interest rate cuts, and markets were moving ahead on the basis that we'd come to a very difficult time period, 2022, recovery, 2023, resilience. But quarter one from quarter four last year has moved in the direction of being the strongest quarter for markets since the last 5 years. Right. So, Marty, there is a lot of headwinds, and again, our hearts go out in terms of Ukraine and in terms of the Middle East, etc. And we have to take that into account. That's going to be part of the story as we go through 2024. But in the main, when we're looking from the financial side of things, I think you're looking at a situation of what I call now the four I's. Okay. It is inflation. It is interest rates. It's the income earnings from corporates. And where do we see the investment growth coming from? So it's those four I's, I think, that we are probably looking at in terms of where do we see it going. And our view here would be that we've had a very strong quarter, but it's been very narrow in the sense that it's very tech-driven. So you're looking at a situation whereby markets are up double digits. We've had strong performance from America, the S&P. We've had strong performance from Japan. It's at its highest level in 35 years. Right. We've got the European markets, the Europe Stocks 50, up at high levels at 23 years. So it has been a very strong quarter in terms of the growth side of things. But behind that, you have the Fed and you've got the ECB saying, well, we're not going to move on interest rates because we're still seeing sticky inflation. We're still seeing items where we're not prepared yet to start doing the interest rate cuts. But I think the market has embraced that in that context. So we're of the view that they will proceed with caution. Yeah. And it could be the second half of the year before they have all the data, because it is now data-driven. So the critical thing here is that if the numbers are coming through on inflation, albeit sticky, if the numbers are coming through in terms of it, they're heading down in the right direction, I do believe that we will still see the next 3 quarters being positive despite the headwinds that are out there.
Yeah, I'd agree. I do think the numbers are the key to this. And if you saw last night, it just happened, we have the US CPI numbers came out. Market had been anticipating that would start to ease down a bit. Instead, it didn't. It's actually came in at 3.5% core CPI, which suggests that interest rates are not going to be cut, and as we had thought in June. And in fact, all the estimates in the market are now that rather than there being 75 basis point cut over the course of the rest of this year, there'll probably be only about 0.4% cut. And that may not even start until September. So you could see a slight softening off in that. Now, against that, today we have the ECB meeting today. ECB is expected to leave things as is, but there's a very strong view in markets that the next ECB session will announce a first European cut. And the reason for this is that European inflation has actually come down quicker than US inflation. And if you look at Ireland, we're now, like last month, we were below 2%. We do have our own inflation numbers coming out at 11 o'clock today. So expectations are that this lowering of inflation will continue. And if that's happening across Europe, then you're going to have Europe being the first one leading, whereas America was the first one to lead on the way up. You could have Europe being the first to lead on the way down. But and the markets are positioning on that basis.
Right.
So you may find a more move towards European markets in this quarter and less drive on in the US,
Yeah.
And I think from the US as well, you're looking at, it's an election year.
Yeah.
And you're looking at a situation whereby you do need to see inflation numbers coming back into that realm, of below 3%. And I think the second half is where the Fed are probably looking at that in terms of making sure that the numbers are backing that before they come back. The US economy has been very strong. We saw just recently non-farm payroll coming in with 300,000 extra jobs. So you're seeing an economy that's been very resilient. It's still our view that for the year 2024, we're going to have a soft landing.
Yeah.
And that is a very strong position to be in terms of coming out of the first quarter.
Yeah, like the geopolitical situation in the States where America has got an election in November, there's always a question as to whether the Fed will move just before an election because they don't want to be seen to influence the election. So that's why the concerns overnight really on that, and could there be a move maybe in end of August, or would there be no move until after the election? There's also a review in the States, and it's gone very political, that some of the numbers are not really reflecting exactly what should happen. So there's suggestion that a lot of the new numbers are actually government, state jobs as opposed to private sector. So questions on all of that is going on the whole time. And it's going to be a very interesting summer, as in America, there'll be a lot of focus on the economy and what's real and what isn't real. So from our point of view, what we have to do is look at where the value is in companies, what the multiples are, how the earnings are coming through, which is what Danny was saying, the eye in the four eyes. Yeah. And we'll focus back into those areas really,
Yeah, that's an excellent summation, guys. And just looking at the interest rate specifically, Paul, you mentioned the possible timings. Undoubtedly, the eyes of the financial world will be focused on central banks. Have been and will be for the rest of this year. What factors do you think will influence their decision on interest rate cuts? And in your view, is it a case of higher for longer?
Well, as I was saying, I think for America, it's going to be higher for longer. So it'll be the back end of the summer now before we see any move. And as Danny said, they really have to see that the economy has calmed down, because if the economy continues to grow in the States on the basis of higher numbers, well, then they'll leave them higher. Yeah. There's no need to cut, because all you're doing is throwing fuel onto a fire. Yeah. In Europe, definitely, our economies are coming off a lower level, so the ability to cut interest rates is much higher, and definitely we're still looking at a cut probably in the beginning of June in Europe, and that will add stimulus definitely to the European economy. Now, the sentiment, very interesting sentiment in Europe has started to shift. So it's gone from a very negative, a lot of the sentiment indexes were in a strong negative position, and the most recent numbers that are coming out are showing sentiment has improved across Europe. The big driver in Europe is Germany. Their exports had fallen, but they're starting to see a turn.
Yeah.
And if Germany if the engines of Europe starts to move, then the European economy in general will start to move forward.
Do you envisage 2-3 cuts by the year end?
In Europe, I do. I think definitely 2, possibly 3. But they'll allow a cut and they'll wait and see. But you could see 3 cuts over the course of the year.
And again, the timing of those, I think we're probably of the view that it's sometime during the second half of the year.
Yeah.
And that would be welcome news for people with mortgages and fixed rates, et cetera. So underpinning all of that and back to the income side of things and earnings, that will support equities and equity markets going forward. So we're of the view that certainly if we have been able to live with a very steep rise in interest rates and the costs that are associated with that, and they're now moving in that downward trajectory, whatever that timing may be. I think markets will look through that, and then you're looking at, well, will that support markets throughout the remainder of the year, Marty? We've had double-digit growth in quarter one. If we had the full year with double-digit growth, we'd be very happy with that. Do we see that there's still a momentum for that, despite the headwinds and the geopolitical tensions that are there? I think we're of a view that we still have room to grow, simply because the growth that we've seen so far has been very narrow. And I can go into that in a little bit more detail.
Yeah, sorry, Paul.
And just on that, like the whole more interest rates, what's interesting is that our mortgage business is seeing, for the first time, rates starting to fall. We've had 2 houses have announced recent interest rate cuts for long-term borrowers. So this is where we see it going. We definitely see interest rates falling over the course of this year, and the banks are voting with their feet because they're starting to offer lower rates in anticipation of that.
Yeah. And you touched on equities there, Danny. It has been a rising tide for sure, led by the tech dominance and that so-called Magnificent Seven. I mean, is there still value there, or do you see the value elsewhere?
That's the key. When you see headlines that markets are at their highs, people are saying, well, oh my God, there's no more room to maneuver. It's not a fact, because index levels can deceive people, because I'm looking at the world MSCI index, for example. It's at the same level as it was back in 2021. And half of the companies making up the world index have actually underperformed over the last 2 years.
Okay.
So market valuations are probably trading below their average at about 15 times multiples. So that tells me that there is value out there, and you could be overlooking a lot of that value by simply saying, oh my God, markets are all-time highs, etc. You look at the tech domination over the last 5 years, Marty, tech-related companies have delivered 200%. Now, that's a phenomenal. It's twice the average of the S&P 500. But 10 out of the 11 sectors, if I take technology sector, 10 of the others, and I'm talking about healthcare, I'm talking about real estate, I'm talking about industrials, utilities, they've actually underperformed the average over that time period. So there is value out there, and it's about looking at the opportunities that you can actually see that from a diverse portfolio, and we keep coming back, you've got to look through, and you've got to make sure that you have the time for staying in the markets, because there'll be very much up and down. But there is still good value in the markets out there. And even in the bond market actually is down about 1% in this quarter. So the bond market hasn't delivered in terms of where it came off quarter 4 last year. But again, if interest rates are on a downward trajectory, we do see that bond market will add some value to an overall portfolio.
Right.
Again, it's back talking to clients, their long-term goals, objectives, and being diversified, because there is still very strong opportunity over the medium to long term.
So having that balance in your portfolio is important.
Correct.
Yeah. It's and any possibility of a tech bubble emerging in your opinion, or
we are part of our growth themes would be the whole technology and artificial intelligence. Marty, I'm seeing valuations of the S&P 500. It's actually going to be less at the end of this year than it was back 2021. Earnings, again, we've got to look at what's making up the price. You've got earnings and the price, share price. If the earnings are not supporting that, and it's back to what we were saying, that I is income, then you could be in bubble territory. It's not. The actual earnings from the companies, and I take NVIDIA. NVIDIA has been a star performer over the last while, but their earnings are keeping pace with where the share price is. So it's not gone into that bubble territory. You get worried if suddenly you're looking at earnings and they're not driving where the share price should be. But out of the Magnificent Seven, there are 5 of them are doing fine in the first quarter, but Tesla has dropped 29%. Apple is down 7%. So there is a mix. And one stat I would like to highlight, 38 years ago, this quarter, Microsoft came into being on the 13th of March, 1986. It came on the market at $21 a share. It's trading currently at $415 a share. Its annualized growth is 26% per annum. And you compare that to the S&P 500 over that time, which has been a very good 10.6. But it just shows underlying the markets and underlying your index levels that you're seeing at the moment, are there valuations or companies, back to company selection and fundamentals?
Right.
We believe there are.
So if looking at the equity situation that Danny's just outlined, Paul, in the context of Ireland, we have a new Taoiseach and we have an election looming. The potential change, is there likely to be any significant impact on our economic growth, which continues to impress, obviously?
Yeah, well, I suppose a couple of things to look at. Firstly, in the context of what Danny was just talking about in terms of where markets are, the Irish market has actually been the most successful performing market this quarter.
Right.
And we're back at a level where we were nearly 10 years ago, back in 2007. And it's the actual performance of stocks has been phenomenal. So the Irish market up nearly 13.5% over the course of this quarter. And, you know, it's been driven across the board in terms of companies, from some of the smaller companies like Malin, which is up nearly 35%. Now it's only a market cap of 100 million, but it just reflects the fact that you're seeing smaller companies starting to grow, through the larger companies still on the exchange. So the likes of Smurfit, Ryanair, Kerry Group, all performing between 10 and 13% over the course of that quarter, which reflects the health of the underlying Irish economy. Now, we did have a technical recession last year, but we're now out of that, and we're now in a growth phase. The ECB has been, or the European Commission has been forecasting that Irish GDP will come in around 1.2 to 1.5 this year, and then rising back up to over 3% next year. The inflation as well last month came in just under 2%. We've numbers out again later today, as we said earlier, which we expect that trend to continue. So that's a very positive backdrop for the economy. As you mentioned, we have a new Taoiseach. He's starting to lay out his parameters as to how he's going to run the next phase. I know in the first quarter, Danny and I had a nice little challenge on each other. I think I'm definitely going to lose this one now, because I do not see us having an election in May. and I don't think we'll have one in November either.
It'll be next year, I think. Absolutely.
Was there much money on that bet?
I think it'll run all the way till the very end. It'll be March next year before they'll probably call the government, call an election. Which will probably play positively into the government's hands, because the big issue has been housing. And now you can see across the country huge numbers of new housing coming on stream or being released. There seems to be a large increase in the amount of rental properties suddenly available. The issue is pricing. It's definitely being pitched at a slightly higher level. Most of the rental stock coming on board are institutionally owned, and they seem to have a minimum rental level that they want for things. So you're going to have a situation now where they'll be able to point to supply, but people may not be able to afford the supply.
Yeah.
And Again, we'll be focusing back towards, if interest rates are going to start coming lower, then mortgages are better value, and that tussle. But that's a positive backdrop. If people people get housing, employment levels are at an all-time high in Ireland, with the highest growth in our economy, the highest number of people employed in the country. So a positive backdrop.
Again, good news from Ireland: 43% of our electricity in March came from renewables.
Yes.
So we're doing a lot of the right things in terms of what we need to do from climate, which is very important, and indeed in terms of helping our own energy production as we go along in terms of the next number of years. Yeah. So I think I'd agree. Tailwinds, yes, of course, but I think on the whole, good backdrop.
Just move on, Danny, to an area of expertise for yourself. You've had a lot of experience with structured investment solutions and with successful maturities around particular themes.
Yes.
Can you identify for us and for our viewers, what would the key growth investment themes be currently that we might watch out for?
Well, in quarter one, we've had about three or four maturities, Marty, from growth solutions that we have had for clients. We had recently a cybersecurity maturity, which again follows the theme that we believe that is a massive growing business. As we are digitalizing and everything else, you are looking at cybersecurity as a growth area. It's affecting every company, every business, every economy. We can see that. So that's more a growth theme, and we would have had a maturity from a structured solution in terms of that. The circular economy, we firmly believe that the right thing to do for the climate is to make sure that we reuse, we recycle, and we are doing everything in a renewable capacity. And I think Ireland is moving in that direction in terms of recently down in Mitchelstown, Dairygold, they have they're now being supplied by a solar energy farm from a local farmer, and it's going to be producing the electricity for the whole of Dairygold, and they are now moving to electric milk delivery trucks. These are the types of things that we're not seeing or hearing in terms of the mainstream, but a huge amount of work being done in solar and wind. And all I would say is that is another key theme that we would be looking at in terms of that. We would have also last year been, we probably talked about it, the metaverse and the AI, etc. And that would have been another one that has just matured as well in terms of growth theme, in terms of structured solutions. The whole semiconductor, I keep coming back to the California gold rush. I mean, the people that made money at those were the people that made the picks and the shovels and the wheelbarrows. Mm-hmm. And the whole semiconductor industry is the one that is going to be supporting the cutting edge microchips that we're using for AI. That's going to be a key growth area that we see over the next decade. So we do see within the equity frames that we're looking at very strong themes in terms of climate, in terms of cybersecurity, in terms of circular economy, renewables, and clean tech.
Right.
Clean tech.
Yeah.
The biggest supplier last year, or the biggest growth area, was in solar. There was 510 gigawatts, the biggest in the history of the planet in terms of delivery. And that is the power that would power Spain, France, and Germany in total. That was new solar energy that came on board. And believe it or not, now Paul and I were talking about this, China delivered 216 gigawatts of that solar, the biggest in history. So countries around the globe are moving to the renewables, and there's a lot of investment going into that, Marty. So that's probably giving you the backdrop.
Excellent. No, that's excellent,
okay?
Danny. And I might refer our viewers to our suite of video insights on the website, which will cover a lot of those topics. So there's an insight on semiconductors and a circular economy there.
Circular economy, etc.
So they're worth checking out. As we normally do, we'll just wrap up with a couple of questions. We've touched on some of this, so you can be as brief as you like. Paul, I'll come to you first. This is on the Irish Stock Exchange, which you did touch on. What's driving the recent strong performance of the ISEC, despite the recent departures of major Irish companies?
Well, it's the Irish economy. It's, as they used to say, it's the economy, stupid. Yeah. And that's what's driving it. And the fact that Irish companies have become very global in their focus. So during, when Brexit happened, Irish corporates were forced to rethink their export plans. And so many companies have moved their focus way beyond the UK and therefore have been able to benefit from growth elsewhere in the world. Now, the shift in the ISAC is really interesting because we've lost CRH, we've lost Flutter. There is concerns that Smurfit might leave the exchange. So the exchange is shrinking in terms of its overall size, but we still have a lot of very strong big companies like Kingspan, Ryanair, Kerry, Bank of Ireland, AIB. AIB came out with really strong numbers this quarter, and both Irish banks actually are performing really well, which you would expect in an environment where interest rates have gone up and they have been able to keep their net interest margin, they've been able to widen it and therefore rebuild their balance sheets and grow their income. So there's still plenty of opportunity within the Irish market. The issue, though, is that you have a group of large cap and then you've quite a lot of smaller cap. And so from an investing point of view, we have to watch that and be careful because you add extra risk to portfolios if you take too much exposure to smaller companies.
Sure.
But in Seaspray, we have access to all world markets. So we balance off any investor's interest that they may have in Irish with international stocks. And we don't need to play small stocks to get, extra benefit. You can play large caps in different parts of the world. So that is something we can do.
Terrific. That's excellent, Paul. And Danny, for yourself, just touching back on equities again. The question here from the client is, with markets at an all-time high, do you still see value in equities going forward?
Yeah, I think I've probably gone through that, but I think the answer is yes. To me, a high, it can be deceiving because I think when you're looking across index levels, it tells a different story. It's like tip of the iceberg, what's happening underneath. When we look at what's happening underneath, there is strong value out there, Marty. And all I would be saying to clients, back to what Paul said there, you can be well diversified and across sectors, and we can build structures and solutions, which we do for clients, which can be tailored to meet everyone's risk profile and time horizons. And I think it's no more than the Irish market might be doing well or whatever. It's not putting all eggs in a basket that is a small economy. You've got to be very much looking at what do we believe from a strategy and theme going forward internationally do we believe in, and there are plenty of those opportunities.
Brilliant. Okay, excellent, guys. Well, unfortunately, the clock has beaten us yet again. So that's super stuff, guys. Really, really good today. Thanks for your excellent insight.
Can I mention one thing about Ireland?
Before we go, yeah.
I was traveling from the Wild Atlantic Way this morning. And believe it or not, the Wild Atlantic Way only came into being 10 years ago. And 10 years ago to date, it is creating $3 billion a year for the Irish economy and creating 35,000 jobs. So when we're talking about Ireland, 10 years ago, this didn't exist. What I'm looking at in the technology side of things and AI, 10 years ago, things didn't exist. There are going to be a lot of developments happening over the next 10 years. Right. And we believe we can actually create those solutions for clients.
Great. God, that's remarkable, really. That great success story. And thanks for that little nugget.
The weather wasn't great, but
Okay, so thanks again, guys. Okay. Really appreciate your input. Much appreciated.
Thanks, Marty.
To read more detail on today's discussion, I encourage you to log on to our website and download for free the Q1 Investment Review and Outlook document research. And as I said earlier, to subscribe for free to our suite of market updates, including our weekly market review. We'd be delighted if you could follow us on our LinkedIn page and like and share our content from there. And just to recap, the podcast series is available now on the Apple, Spotify, and YouTube platforms. You can subscribe for free to our dedicated YouTube channel, and we'd be delighted to share with you our video content from there. So that's it for today. Thanks for tuning in, and we'll see you next time. Bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Thank you.